Okay, let's get some more insight on what stocks are doing today and what we might see in the next week or two. Joining us live from Delaware, Eddie Ghabour of Key Advisors Group. Eddie, thanks for coming back on the show.
Thank you for having me.
So let's talk about the latest news. We saw a little bit of a concession from President Trump delaying the raise on tariffs from October 1 to October 15 now, notwithstanding this breaking news that maybe Trump advisors are considering something like an interim deal, but we are seeing markets move a little bit higher right now. What do you make of kind of the latest news about supposed developments on tariffs?
You know, I think the main thing here to see is there's still a lot of uncertainty on trade. I do not think that we're going to get a comprehensive deal in October. If we did, make no mistake, I do believe the markets would catapult up and blow through new highs. This is not the first time we have heard this type of rhetoric that we are close to a deal or things seem to be going in the right direction. The only way we will get some type of deal is if we back off our demands on intellectual property. And I don't think that's going to happen. So right now, anyone that is overweight equities and has retired or close to retiring, it is of my opinion to take days like today of strength and take a little bit of profits and put it on the sideline, because I think we still have a lot of headwinds ahead of us that could potentially cause markets to head back down.
So you're talking about days of strength, but we know that the Fed is likely going to cut interest rates this month. Do you think that's going to send the market to new highs, or do you think that the trade war overhang is going to prevent that from happening?
Well, I think the market's already priced in a 25 basis point cut already. So the only thing the Fed could do to derail markets is to either not do a Fed cut, which the market would probably go down, or if they make an aggressive cut of 50 basis points. At that point in time, that may actually spook the markets as well, because then investors are going to say, why are they being so aggressive? Is the economy not as strong as we are being told? So right now, I think that's already priced in, the 25 basis points, so it shouldn't be too much movement in the markets. China and U.S. trade is the number one issue that's going to cause this market to break through new highs or go down, because make no mistake, the globe around us is slowing and heading to a recession. If this trade war escalates into the latter part of next year with these tariffs, it's going to affect the consumer. It's almost impossible not to. And then our slowdown that we will be seeing could potentially turn into a recession in the second half of next year or the beginning of 2021. So my point is, I'd rather be a little bit more defensive when we're near all-time highs and be prudent, even if it's a little bit early, versus being caught.
Yeah, but look at the last time we were at all-time highs in late July. At that point, you had a 10-year yield that was over 2%. Now it's at about 1.7, 1.8%. So just in the past 6 weeks, we have stocks more attractive because interest rates are lower.
Sure, but are interest rates lower because of the bond market is seeing a slowdown economically? Look, I've been very, very bullish in the markets over the last few years. After the first quarter of this year, I started to become a little bit more cautious. So I'm not saying jump out of the market. I'm saying for an investor, if you're overweight equities, be a little bit prudent here, because keep in mind, we've had this yield curve inversion as well, too. That's another cautionary sign. So again, hogs get fat, pigs get, well, I'm screwing that up right now, but I think you get my point. Just don't be greedy at this point in time.
Pigs get slaughtered.
Right.
That's it. I apologize.
No, it's good. All right, Eddie. Thanks so much. I'll be back on soon.
Thanks.